Welcome back. This is Brian J. Decker with your weekly market update. A lot of things happening this week. We have a new president, a transition. We have markets still going up with the expectation that the stimulus package that the Biden administration has announced will find its way into the stock market like it typically does. We have the expectation, a very high expectation, that the virus vaccines will work and there's no problem with any mutation in the viruses. We also have an interesting report coming out of UBS saying that there's a chance that Bitcoin could go to zero. An interesting article that they talk about how the G7 countries don't want a competing currency and may shut it down. China's already said that Bitcoin is an unofficial, unacceptable currency for that country. They don't want a competing currency to the Chinese yuan. Interesting developments in the credit markets. I just saw this morning a graph that I bet I will never see again in my life. And it shows the spread between high yield bonds and US Treasuries at the slimmest margin ever recorded on history. Now that's a fancy way of saying that you're not getting much yield anywhere. So the 7 to 10 year Treasury is yielding 1%. What about a company like XYZ Movie Studios? No, forget about that. XYZ movie theater chain that's been shut down all year and is on the verge of going bankrupt, and their credit is single B, just a couple notches before D is in default. What's your rate of return on a 10-year junk bond like that? Not much better. So this is uncharted territory in the case of the announcement of Bitcoin, in the spread of between a riskless rate on US Treasuries and high yield junk bonds being tiny narrow, and the market valuation, which you've heard me talk before. Whenever we get above 30 times earnings, that's very rare. So I hope you have downside protection in place. Indexing, not very good for retirees, fantastic for someone in their 20s, 30s, and 40s. Low fees, diversification with 500 companies in the S&P, and you own the index that beats 85% of money managers and mutual funds. That works in your 20s, 30s, and 40s. In retirement, one problem, zero downside protection when the markets tank. And historically, how has the markets done when they're above 30 times earnings? Historically, they have never, not one time, they have never made money over a 10-year period. So I hope that you take a look at your strategies at risk, find out what level of risk that you should be at and how much money should be at risk, and we do all of this for you, and then make sure that you have downside protection, because the markets in the next 10 years are not going to be anything like the markets in the last 10 years. If you don't have downside protection in place in your risk accounts and you're taking way too much risk in your current risk accounts, you may have to go back to work, you may have to sell your home, you may have to move in with the kids. None of those are good plan Bs. Do something about the risk exposure you have. Make sure it's commensurate with the risk that's acceptable to you. We can help quantify that. If you contact us and let us know, we can set up a quick 15-minute meeting and get you all set up. So I hope you have a great rest of your week. This is Brian Decker signing off for our weekly market update.